Welcome to the deep dive. Today we're diving into a company with a really bold ambition to redefine how money actually moves in our digital world. We're going to take a stack of information articles, research our own insights, and try to distill it down into the most important nuggets for you. Our focus is Circle Internet Group, trading as CRCL. As of our analysis date, August 31st, 2025, it's Class A common stock closed at $131.98 per share. So here's the hook for today. What if the US dollar could move at like the speed of the internet, 24/7, none of the usual friction with banks? What would that company be worth? And just to give you a preview of where our analysis lands, our educational model estimates an intrinsic value range between $110 and $150 per share. So keep that in mind as we go.
That's exactly the core question we're digging into, is Circle that company? Not just playing in the digital asset space, but actually building the fundamental plumbing for a whole new era of fine games. We'll explore what makes it tick, its future potential, the big challenges too, making sure you walk away really well informed.
Right. And to give you a clear roadmap, we split this into two parts. Part one, we lay the groundwork, the business, management, financials. Then in part two, we'll shift over to market sentiment, ownership, risks, and wrap it all up with our conclusion. Part one, the foundation. Okay, let's kick things off with chapter one. Business analysis, the engine of a new financial system. So let's unpack Circle's core business. What exactly are they doing and how do they, make money?
Okay. So at its heart, Circle is the main issuer of USD Coin, or USDC, that's a stable coin, pegged one-to-one with the US dollar. So when you want USDC, you give Circle actual US dollars, and they mint the same amount of USDC onto a blockchain. And crucially, those dollars you give them, they don't just sit there. Circle invests them in reserves, mostly cash and short-term US government securities, like T-bills.
Okay. And that investment strategy, that's key to their revenue model, isn't it?
Exactly. That creates two main ways they make money. The biggest is reserve income. That's the interest they earn on those massive reserve holdings. Just to give you a sense, in Q2 2025, that was $634 million out of their $658 million total revenue. So you can see it's incredibly profitable when interest rates are positive. The second stream, which is growing fast, is other revenue. Things like fees from subscriptions, platform services that jumped 252% year over year, hit $24 million in Q2. So they're clearly trying to diversify beyond just the interest income.
Right. Diversifying makes sense. And beyond just USDC itself, what else are they building? It sounds like more than just one product, like a whole ecosystem.
Absolutely. Yeah, ecosystem is the right word. USDC is the flagship for sure, but they're building out a whole suite. There's Eurocoin, URC, backed by euros. There's USYC, which is interesting. It's a yield-bearing version of USDC for institutions. It's actually used as collateral now on places like Binance. They've also got the Circle Payments Network, CPN. That's for financial institutions. Sounds like over 100 are in the pipeline there. And maybe the most ambitious thing, ARC. That's a brand new open layer 1 blockchain. Think of it like a dedicated highway just for stablecoin finance. And USDC is the native gas token on ARC. So USDC isn't just the money, it's also the fuel needed to make transactions happen on that network. Plus, Circle Gateway lets you use USDC across different blockchains easily.
Okay, so this is where it gets really interesting for me. It's not just a product company anymore. It feels like they're becoming a platform company. Can you explain that shift? Why is that so significant?
That's precisely the point. Yeah, a product company sells, USDC. A platform company builds the underlying rails for a whole system, like an internet-native financial system. USDC becomes a core piece, sure, but it's not the only thing. This allows for huge network effects, makes the whole system stickier for users.
That makes sense. So how big are they then? What's the scale we're talking about here?
The scale is pretty staggering. As of end of June 2025, USDC in circulation was $61.3 billion. That's up 90% year over year. And it climbed even higher to $65.2 billion by mid-August. Historically, USDC has settled over $25 trillion in on-chain transactions. Just in Q2 2025 alone, it was $5.9 trillion. That's like 5.4 times higher than the year before. This gives them a really strong 28% share of the fiat-backed stablecoin market. And the key takeaway here, I think, is that scale builds trust. And trust attracts more users, which builds more scale. It's that virtuous cycle.
A virtuous cycle, right. So with all this tech and scale, what's the core promise to users? What problem are they solving?
The core value prop is really about providing a regulated, transparent, and importantly, programmable digital dollar. They're tackling the old problems of traditional finance, slow settlements, high fees, banks being closed nights and weekends. By using blockchain, they offer near-instant, low-cost 2047 global value transfer. It ties right into their mission statement: raise global economic prosperity through the frictionless exchange of value.
Frictionless exchange. Okay. So that Circle's promise, but
Right.
what about the wider industry? What are the big trends? Where is this whole stablecoin market heading?
Well, the market itself is just exploding. Projections show it growing from about $166 billion in June 2025 to maybe even $1 trillion by the end of the year. That's incredible growth. And it's not just crypto speculation driving it, it's real-world use cases, especially cross-border B2B payments. Stablecoins are just faster and way cheaper for that. Get this, they already account for over 43% of those kinds of payments in Southeast Asia.
Wow, 43%. So you're saying businesses are ditching the old, clunky international wires with all the hidden fees and delays
Right.
and just using stablecoins instead, like sending an email. That sounds like a massive shift.
It really is. It's a total game changer, especially for businesses operating internationally. That's why you're seeing such rapid adoption, particularly in regions where those old systems were always a major headache.
Okay, so huge market growth.
Mhm.
Who are the main players Circle's competing against?
The big showdown is really between Circle's USDC and Tether's USDT. Now, Tether has a larger market cap today, but USDC is definitely gaining ground, especially in markets that care about regulation. Actually, USDC's transaction volume overtook Tether's back in April 2024, so what you're seeing is the market kind of splitting. Tether operates with, let's say, more regulatory ambiguity. Circle, on the other hand, has leaned into regulation and transparency, and new rules, like the MiCA framework in Europe, are actually causing some platforms to limit USDT, which directly helps USDC. Beyond those two giants, you've got decentralized stablecoins like DAI, and even traditional players like JP Morgan are starting to dip their toes in with their own offerings.
You mentioned regulation. For a lot of crypto companies, that's seen as a bad thing, a headwind. But for Circle, it sounds different.
Oh, absolutely. For many, regulation is a hurdle. For Circle, it's arguably their biggest competitive weapon. The key piece of legislation is the Guiding and Establishing National Innovation for U.S. Stablecoins Act of 2025. They call it the Genius Act, signed into law July 18th, 2025. It creates the first real comprehensive federal rulebook for payment stablecoins in the U.S.
Okay, the Genius Act. What does it actually do? Why is it such a big deal for Circle specifically?
So the key parts are, it mandates 100% reserve backing only U.S. currency or short-term U.S. government debt. No funny business with reserves. It requires monthly public reports on what's in those reserves. Transparency. And it officially labels issuers like Circle as financial institutions under the Bank Secrecy Act. That means strict rules for anti-money laundering, AML, and Know Your Customer, KYC, verifying who's using the platform. The bottom line, this law basically takes Circle's existing way of doing business and writes it into federal law. It creates a massive regulatory moat and makes USDC look much safer, much more appealing to big institutions.
A regulatory moat. So it's much harder now for someone new to just jump in and compete. Raises the barrier to entry quite a bit.
Immensely, yeah. You've got to navigate all these complex state and federal rules like the Genius Act. You need partnerships with trusted banks and custodians, big names like BlackRock, and you need a ton of capital just to get the scale and build the kind of trust that's required now. It's a very high bar.
Right. So that leads us to competitive advantages. Regulation is clearly one huge one. What else really sets Circle apart?
Well, first, definitely brand strength. They've worked hard to build a brand around trust, transparency, compliance. USDC is seen as the safe, enterprise-grade digital dollar. Second, economies of scale. Managing over $65 billion gives them real clout when negotiating with custody partners like BlackRock or asset managers, lower costs for them. Third, powerful network effects. The more places USDC is used, exchanges, DeFi platforms, businesses, the more useful it becomes, making it harder for users to switch away. And finally, unique assets. They have this really sophisticated global policy team that's literally helped shape the rules. And things like their own ARC blockchain are becoming key differentiators.
Okay, let's shift gears. Chapter 2. Management evaluation. The architects of trust. Let's talk about the leadership. Who's running this show and what's their background?
Yeah, the leadership team and the board, they seem very deliberately chosen to project credibility. You've got Jeremy Allaire, the co-founder and CEO. He's a serial tech entrepreneur. He took 2 other companies public before Circle, Cold Fusion, and Bright Cove. That shows he knows how to build and scale tech businesses successfully. That's pretty rare.
And that board composition,
Yeah.
it really stands out for a tech company, doesn't it?
Yeah.
What's the actual strategic benefit of having all that traditional finance and regulatory muscle at the top? How does that really help them?
It's a huge strategic advantage. It's not just for show. It means they can speak the language of Silicon Valley and Wall Street and Washington, D.C. all at once. That lets them navigate these complex worlds, tech innovation, financial markets, regulation in a way most tech startups just can't. Take Heath Tarbert, their president. He's the former chairman of the CFTC, the main derivatives regulator, and was chief legal officer at Citadel Securities. Deep TradFi and regulatory cred. The board is similar. Craig Broderick, former chief risk officer at Goldman Sachs, Rajiv Date, first deputy director of the Consumer Financial Protection Bureau. These aren't typical tech board members.
Definitely not.
No.
How transparent are they, though, with the public, with investors? Is that part of the brand image?
Oh, absolutely. Transparency is central. Allaire himself is very public-facing, always talking to media, engaging with policymakers, and the company backs it up. They publish regular attestations of their USDC reserves. That's been absolutely critical for building trust, especially in the crypto space, which can be, well, pretty opaque sometimes.
Makes sense. What about how they use their capital, especially after that big IPO recently? Are they giving money back to shareholders or just reinvesting?
Right. They had their IPO back in June 2025, raised about $583 million. As you'd expect for a newly public, high-growth company, the strategy is all about reinvesting back into the business. They want to grab market share. So that capital is going towards organic growth, building out things like the ARC blockchain, the Circle Payments Network, not really focused on M&A right now or shareholder returns.
So no share buybacks for dividends then?
Correct. No history of buybacks or dividends. The whole story for investors is about reinvesting for growth. The bet is on long-term capital appreciation, not income.
Okay, so if they're reinvesting heavily, how efficiently are they using that capital? We look at return on invested capital, ROIC, right?
Exactly. ROIC is the metric. But honestly, for a company that just went public and has all these big one-time non-cash charges from the IPO messing up the standard job earnings, calculating a meaningful historical ROIC right now is really tricky. However, the underlying business model itself, earning interest on those huge growing reserves, that has the potential to be extremely capital efficient. It should generate high returns as the business scales and matures. But yeah, it's definitely a key metric for you as an investor to watch closely going forward.
Yeah, let's get into the numbers. Chapter 3, Financial Analysis, Translating Vision into Value. So market cap, where does Circle stand today?
As of August 29, 2025, market cap was sitting at $30.54 billion.
Okay, $30 billion. And revenue growth. You mentioned it earlier, but what's the 5-year picture look like? Has it been a smooth ride?
Explosive is the word, but definitely not smooth. I mean, it went from like $15 million in 2020 to over $1.6 billion in 2024. But what's really fascinating is the reacceleration in the last 12 months. The TTM revenue is $2.12 billion. That's up 174% year over year. Why? Well, partly the crypto market recovering, but crucially, rising interest rates boosting that reserve income. It really highlights how sensitive the business is to both crypto sentiment and what the Fed does.
Right, the Fed dependency is key. Now, profit margins often tell a different story than just revenue. What do we see there, especially considering the recent IPO noise?
Yeah, if you just glance at the recent GAAP numbers, you might get the wrong idea. Q2 2025. $658 million revenue, but a reported net loss of $482 million. But hold on, that loss was entirely because of $591 million in one-off non-cash charges related to the IPO. Mostly stock-based compensation, 424 meters, and a convertible debt charge, 167 meters. If you strip those out, their adjusted EBITDA for the quarter was actually a positive $126 million. That's a very healthy 50% adjusted EBITDA margin, so the core operation, highly profitable.
Okay, that adjustment is important. So are they actually generating cash then? Or still burning through it like a startup? What about free cash flow?
Free cash flow, FCF, is crucial. And here the story is good. Circle went from burning about $83.5 million back in 2022 to generating nearly $300 million in FCF in 2024. That shows really powerful operating leverage. As revenues shoot up, the extra costs to handle that revenue are proportionally smaller, so cash flow expands nicely. And having strong FCF like that lets them fund big projects like the ARC blockchain without having to go back out and raise more money.
How's the overall financial stability? Balance sheet looking okay?
Yeah, earnings consistency has been choppy because of market swings and those IPO charges, as we said. But the balance sheet itself looks very strong. Very low debt-to-equity ratio, just 0.09. Their current ratio is 1.03, which suggests they have enough liquid assets to cover short-term bills. But yeah, remember, no dividend currently.
Okay, let's talk valuation. For a company growing this fast in such a disruptive area, how should we think about the current stock price?
Well, because of that recent gap loss, the usual trailing PE ratio isn't really meaningful. But the forward PE, which uses analyst forecasts for future earnings, that's extremely high. It's at 147.05. A multiple like that tells you the market has baked in really high expectations for future profit growth. There's not much room for error or disappointment. It's pretty typical, though, for leaders in these kinds of high-growth, disruptive industries.
Right, high expectations priced in. So to get a better sense of underlying value, we often turn to intrinsic value models, like a DCF.
Absolutely. A discounted cash flow, or DCF, analysis is the way to go here. Basically, you forecast the company's future free cash flows, all the cash it's expected to generate over its lifetime after expenses and investments, and then you discount those future cash flows back to what they're worth today. It's a way of valuing the business based on its long-term cash-generating power.
Makes sense. But those models depend heavily on assumptions, right? What are the key ones for Circle in this educational model?
Exactly. Assumptions are everything. And we need to be clear. This is an educational model. So for Circle, we assumed an initial 5-year high growth phase. That reflects management's own target of around 40% annual growth in USDC circulation, and that broader market potential heading towards, maybe $1 trillion. After those 5 years, we taper the growth down to a more sustainable 3.5% terminal rate forever. And because Circle is newly public and it's in a volatile sector, we used a relatively high discount rate, the WACC, or weighted average cost of capital of 13.5%. That accounts for the higher risk.
Okay, high growth and tapering, high discount rate. So running those assumptions through the educational DCF model, what did it spit out for Circle's estimated value?
Based on those specific assumptions, our educational estimate for the intrinsic value range for Circle stock comes out between $110 and $150 per share. And I really have to stress, this is an educational estimate. It's highly sensitive to those growth and discount rate assumptions. Change them even a little, and the value range can shift significantly.
Part 2, the horizon. Okay, let's shift to part 2, starting with chapter 4, market sentiment, the voice of the street. What's the general feeling on Wall Street about Circle right now?
Well, it's pretty divided, actually, which isn't too surprising for a newly public company in a space like this. Looking at 11 analysts covering the stock, the consensus rating is basically a hold, but the price targets are all over the map. You've got JT Morgan down at $80, pretty bearish. Then Needham is way up at $250, very bullish. The average target is around $164.20. So this lack of agreement suggests the market hasn't really settled on a clear story for Circle yet, and that, that could be an opportunity for you, the listener, to form your own view.
Interesting split. What about recent news? Media coverage has been mostly positive, negative, mixed.
Since the IPO, the general media tone has been, I'd say, largely neutral to positive. Lots of focus on the IPO itself being successful, the strong Q2 revenue we talked about, and new strategic partnerships they're forming. There's also been quite a bit of commentary on the stock's volatility. I mean, it shot up to almost $299 after the IPO before pulling back sharply, so volatility is definitely part of the story.
Yeah, that's quite a swing. What about other market indicators like short interest? What does that tell us?
Right, short interest measures how many people are betting against the stock. As of mid-August 2025, it was at 6.07% of the public float. Now, that's not extremely high, but it's significant. It tells you there's a notable chunk of the market thinking the price might fall further, maybe because of that high valuation or the dependence on interest rates we discussed.
Okay, and technically speaking, what are the moving averages showing?
This is interesting. The current price, around $131.98, is actually trading just a tiny bit above its 50-day simple moving average, which is $131.06. That could signal some positive short to medium-term momentum is building. However, it's still trading significantly below its 200-day simple moving average, which is up at $158.15. That typically suggests the longer-term trend is still down. So the picture is kind of short-term stabilization after a pretty big drop following the IPO excitement.
Got it. Let's move on to Chapter 5, ownership structure. Who's at the table? Who actually owns Circle stock? What can we learn from the institutional holders?
Okay, so there are about 319 institutional owners holding roughly 78.9 million shares combined. It's an interesting mix, you see. On one hand, you have early-stage venture capital firms like General Catalyst, which still holds about 8.7%. On the other hand, you have the giant index fund managers Vanguard, BlackRock. This creates a potentially interesting dynamic. The VCs represent a possible overhang shares that might get sold as their investment matures. But the index funds provide steady long-term demand as the stock becomes part of major indices. Oh, and Fidelity is also a significant holder with just under 6% of the company.
What about insiders? Does management have much skin in the game?
Yeah.
And what have they been doing with their shares since the IPO?
Yeah, CEO Jeremy Allaire still has a pretty significant stake, around 7.2% of the outstanding shares. That's good alignment. However, since the IPO and the end of the lockup period, there has been quite a bit of insider selling. Looking at the last 3 months, there were 39 sell transactions versus only 10 buys, and specifically on August 18th, 2025, there was a wave of sales reported by top execs, CEO, president, CFO, CTO. Now, some diversification is totally normal for executives after an IPO, but the volume of selling is definitely something to be aware of.
Okay, this is significant insider selling to note. How concentrated is the ownership overall? Do a few big players control a lot?
Yes, it's highly concentrated. The top 25 shareholders control almost 64% of the entire company. That's a big chunk if you break it down by type. Institutions own about 33%, the general public owns 32%, those VC and private equity firms own about 19.5%, individual insiders like Allaire hold 9%, and other private companies own the rest, about 6.7%. So what that means is decisions made by a relatively small group of large, sophisticated investors can really move the needle on the stock price.
Right, concentration risk. Let's broaden out again with Chapter 6. Risk assessment, navigating the headwinds. Let's use a SWOT framework. Strengths, weaknesses, opportunities, threats. Starting with strengths.
Okay, strengths. We've hit some of these. Number one has to be that regulatory moat built through their proactive strategy and cemented by the Genius Act. Huge advantage. Second, the trusted brand. They're seen as the transparent, compliant option. Third, scale and network effects, that $65 billion plus in circulation, trillion settled, very hard to copy. Fourth, that experienced leadership team blending tech, finance, and policy expertise. And finally, a strong balance sheet, very little debt. Gives them stability.
Okay, solid strengths. What about the flip side? Internal limitations, weaknesses.
Well, the big one is revenue concentration. They are just so reliant on that interest income from reserves, makes them vulnerable to macro shifts, which leads directly to the second weakness, interest rate sensitivity. If the Fed cuts rates significantly, their main revenue stream gets squeezed directly. Third weakness is that high valuation we talked about. That forward PE leaves very little margin for error, high expectations are built in. And finally, maybe a softer point. But those complex gap financials due to the IPO charges, it can make it harder for maybe less sophisticated investors to see the underlying profitability.
Okay, weaknesses noted. Now for the exciting part, opportunities. What are the big potential upsides for Circle?
The biggest opportunity is just the sheer potential market growth. We talked about the stablecoin market possibly hitting $1 trillion as it moves from just crypto uses to mainstream global payments. Circle is arguably best positioned to capture a huge slice of that. Then there's the platform expansion. Things like the ARC blockchain, the Circle Payments Network, these dramatically increase their total addressable market beyond just issuing USDC. Regulatory clarity, like the Genius Act, should unlock more institutional adoption. Big money has been waiting for clear rules. And the ultimate potential. Circle could evolve into like a primary settlement layer for global commerce, a next-gen competitor to Visa or MasterCard. That's the grand vision.
That's a huge vision. But what external threats could stop them from getting there?
Definitely threats exist. Intense competition is one. From Tether, obviously, but also potentially from big banks if they get serious and other fintechs jumping in. There's also systemic risk. If any major stablecoin has a crisis of confidence, a deep pegging event that could cause panic and hurt the entire industry, including Circle, even if USDC itself is fine, contagion risk, and, of course, cybersecurity. Managing tens of billions of dollars makes you a massive target for very sophisticated hackers. A major breach would be devastating. And zooming out, those macroeconomic factors we mentioned, especially interest rates, are a significant threat too.
Right. Remind us how interest rates pose a threat. And what about bigger geopolitical things like those U.S. tariffs from 2025?
So, if the Fed aggressively cuts rates for a sustained period, Circle's yield on reserves drops, directly hitting their main revenue source. That's the big rate risk. High inflation is maybe a broader risk, eroding the value of any dollar-based asset, but that affects everyone holding dollars. Geopolitics, like new trade tariffs, that's more complex. It's kind of a double-edged sword. On one hand, trade friction could disrupt traditional payment flows, maybe slowing USDC use for trade initially. But that very disruption could actually push businesses towards stablecoins like USDC as a way to bypass those new frictions and complexities in the long run. Plus, there's this emerging view in Washington that a strong, regulated, US-based stablecoin network actually helps reinforce the global dominance of the US dollar. So Circle might even get a geopolitical tailwind from that perspective.
Okay, we've covered a ton of ground. Let's try and bring it all together in Chapter 7, Conclusion. What's the strongest bull case for Circle? Why would someone be optimistic?
The bull case, I think, rests on a few pillars. First, they are a clear leader in a massive, rapidly growing market stablecoins. Second, they've played the regulation game brilliantly. They embraced it, built trust, and now the Genius Act basically locks in their model and creates that powerful moat. Third, the leadership is top-notch, visionary, and experienced across tech, finance, and policy. Fourth, they're strategically evolving beyond just USDC into a full-stack financial platform, aiming to be the rails for this new Internet of Value. And finally, the underlying financials, once you adjust for IPO noise, show a highly profitable and cash-generative core business.
Okay, that's a compelling bull case. What about the bear case? What are the biggest risks, the main reasons for caution?
The bear case really boils down to three main risks, I'd say. First, that revenue concentration and extreme sensitivity to interest rates. A shift to lower rates by the Fed is a major vulnerability. Second, the valuation. It's rich. That forward PE means years of near-perfect execution are already expected by the market. Any stumble could hit the stock hard. And third, that ownership structure.
Yeah.
You still have a lot of early VC investors who are likely to be selling shares for a while as they lock in their profits. We saw that heavy insider selling post-IPO. That selling pressure could continue.
Right, so reminding us one last time, where did our educational DCF model put the intrinsic value range?
Based on our assumptions, that educational discounted cash flow analysis estimated the intrinsic value range for Circle stock between $110 and $150 per share.
Okay, $110 to $150, and with the stock currently trading around $131.98, where does that leave you, the listener?
Well, what's striking is that the current share price sits right smack in the middle of our educational value range. So according to this specific model, it suggests the market is currently assigning a, let's say, fair valuation. It seems to be balancing that huge long-term potential against the very real macroeconomic risks and competitive threats. So for you, the decision really comes down to your conviction. How much do you believe in the long-term mainstream adoption of stablecoins? And what's your tolerance for the kind of volatility and risk that comes with investing in a disruptive industry leader, especially during its early years as a public company?
What a deep dive that was. We've really peeled back the layers on Circle, from that clever business model and the huge impact of the Genius Act to the impressive leadership and the sometimes tricky financials. Hopefully this has given you a much clearer, more nuanced picture of this really pivotal player in the future of digital finance.
Yeah, and maybe zooming out just one last time, it raises a bigger question, doesn't it? Beyond the stock price, beyond the tech, what could a truly fictionless exchange of value actually mean? For everyday people, for the global economy, say 5 or 10 years from now, it's definitely something to think about.
Absolutely. Well, if you enjoyed this kind of in-depth analysis, please do like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers, and we're planning to cover all of the S&P 500 stocks over the next few months with exclusive priority access for members. Or if you just want a one-off deep dive on a specific stock that interests you, drop us a super thanks. We'd appreciate it.
And as always, we have to give the crucial reminder. This analysis was generated by an AI system. It's purely for educational purposes. It should absolutely not be considered financial advice. Please, always do your own research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Thank you so much for joining us on the deep dive. Until next time, keep digging, keep learning, and stay well informed.